Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today we have got a practice question from the topic non-current assets. In this question, you will learn to interpret the accumulated depreciation of motor vehicles account, identify the method of depreciation used, and also record relevant journal entries for the depreciation expense and purchase of new assets. You can see the question on the left hand side of your screen, and on the right hand side we've got all the workings which I'll go through and explain to you step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. On the 1st of January 2019, Steph Trading bought two motor vehicles that cost $120,000 each from Primer Trading on credit. The business financial year ends on 31 December. So based on the first paragraph that is given to us, we understand that we bought two motor vehicles at the beginning of the year on 1 January 2019. The cost of each motor vehicle is $120,000, which means the total cost for two motor vehicles is $240,000. And these motor vehicles were bought on credit, all right? Which means we also have some liability happening. And we understand that the financial year of the business starts on 1 Jan and ends on 31 December. So these are the 12 months we are going to focus on when we are working with multiple financial years. Then you can see we are given the ledger account for accumulated depreciation of motor vehicles, okay? So the first part in this question is to define depreciation. Now, depreciation, if you use the simple definition that you are used to already seeing, which is the allocation of the cost for a non-current asset over its estimated useful life, you'll get full marks. But let's apply this definition on a real perspective and how it applies to businesses out there in the real world. So depreciation expense is mainly incurred when we consume the economic benefits that are within the asset to help our business generate more revenue over its useful life. Because ultimately, that is the main purpose of buying a non-current asset. You want to buy the non-current asset in your business so that it can improve the results that your business generates for its customers, right? How much more value or more revenue can the business generate from its customers? So what do you have to do in this case? You can also write the depreciation expense as an expense which is incurred when the consumption of economic benefits happen from the asset, and that consumption of economic benefits gets transferred throughout the business operations to help the business generate more revenue, all right? Now, what about part B? State two causes of depreciation in relation to motor vehicles. Now, motor vehicles are something that we may regularly use in the earlier years of usage, and therefore it will go through wear and tear, and that would lead to a reduced efficiency in the later years, all right? Another thing to look for is obsolescence. Now, it makes sense for us to assume that the two motor vehicles, which costed $120,000 each, are highly technologically advanced because the price, as you can see, is $120,000, all right? So these technologically advanced assets are also prone to obsolescence over time. So in the earlier years of usage, you can extract more benefits out of these assets and help your business to generate more revenue and add more value to its customers compared to the later years, all right? So you could talk about these 2 points, or you could also mention about the legal limitations that you have in Singapore, where you can only have entitlement to a car for 10 years, right? After which you have to get rid of it. So again, the obsolescence factor comes into play in this case, because after 10 years, you're gonna have to get rid of this asset anyway. What about part C? Prepare the journal entry for the purchase of the motor vehicles on 1 January 2019. Narrations are not required. So 1 January 2019 is the first sentence of the question, which mentions about the business buying two motor vehicles for a total cost of $240,000. So when we are buying non-current assets, we have to debit that. So what we are doing is to debit the motor vehicles asset account by $240,000. Again, this is $240 because we have got two assets, $120,000 multiplied by 2. And because a liability is happening during this event, given that we bought these assets on credit, and liabilities, when they increase, we credit them, we would credit specifically the account for primer trading. And I would suggest you write other payables instead of trade payables, because trade payables, I believe, is wrong because it relates to the suppliers of the business from whom you buy on credit. So to separate between the suppliers and other people with whom you do business on credit, the correct account in this case would be to write other payables, and specifically the business primer trading. All right. And we owe these guys $240,000 as well, and we're crediting them obviously because liabilities have increased. All right. What about part D? State the method of depreciation used by Steph Trading. All right. Now, we clearly understand by going through the question so far that no assets have been sold. All right. And if you were to carefully look into the ledger account for accumulated depreciation, you will see that at the end of the first financial year, which is 31 December 2019, the depreciation expense recorded is $24,000. But then the end of the second financial year, which is 31st of December 2020, the depreciation expense recorded is $21,600. So we can clearly see that the depreciation expense goes down as we move from year 1 to year 2, which validates the fact that they're using the reducing balance method, all right? Because reducing balance, as the name is pretty obvious, it means that the depreciation is going down as you move to the later years compared to the earlier years. All right. What about option E? Question E. So explain whether it is appropriate for the business to use the straight line method for the depreciation of motor vehicles. So as we have already discussed before, more economic benefits are consumed in the earlier years of usage for technologically advanced assets that we're working with, which are the motor vehicles. Therefore, more economic benefits are consumed, which leads to higher depreciation expense incurred by the business in the earlier years of usage, right? And in the earlier years, the business can also benefit from increased revenue, right? So therefore, what we can see is that the output of the value that we extract from these assets can decrease over time because of the wear and tear and obsolescence it goes through. Therefore, it makes sense to use the reducing balance method for motor vehicles because we expect a higher depreciation expense to be incurred from the consumption of higher economic benefits to help the business generate more revenue in the earlier years of usage as compared to the later years of its useful life. Okay? All right. So let's do part F. The business bought a new motor vehicle costing $72,000 by check on the 1st of March 2021, and the business will depreciate them at 10% per annum. The requirement is to prepare the journal entry to record the depreciation of the motor vehicle for the year ended 31 December 2021. Narrations are not required. All right. Now, the asset that we're working with in this question, so we understand that we purchased this asset on the 1st of March 2021, right? So from 1st of March 2021 until the end of 31st of December 2021, we have got 10 months that this asset was used in the year 2021, okay? The cost is $72,000, and the question does not mention anything regarding applying a full depreciation in the year of purchase, as you may be used to seeing in many questions that you have practiced before. So in this case, we are confident that we are not doing a full depreciation. Rather, we will adjust the depreciation based on the number of months the asset was used in the year 2021. So depreciation expense can be calculated simply by taking the given rate of 10% and multiplying it with the original cost of $72,000. All right. Now we understand that the 10% in itself is an annualized rate. And we also understand the asset was in use for 10 months. Therefore, we will convert this annualized rate into a 10-month rate by multiplying with 10 over 12. So that takes care of all the adjustments that are required. So which gives us a depreciation expense of $6,000 for this new asset for the year ended 31 December 2021. All right. Okay. Now, so the question is asking us to record the depreciation of the motor vehicles for the year ended 31 December 2021. So when you read this, you have to assume that you have to record the depreciation for all the assets, which includes the new assets and the old assets, okay? Now, so let's look into some extra calculations. So in between the 1st of Jan and 2021 and 31st of December 2021, the new asset which we bought had a depreciation of $6,000, which we have just calculated, right? Now, let's look into the old assets. Before, we have identified that we are doing the reducing balance method based on the depreciation expense, which is clearly decreasing from one year to the next in the ledger account. We also know the rate is 10%. And when you're using the reducing balance method, you always would want to find out the net book value at the end of the financial period. So the most recent financial period for the two old assets that we have based on the ledger account is that it ended on 31st of December 2021, right? So we want to find the net book value at 31 December 2021, and we do that by taking our original cost for these two assets and subtracting the accumulated or total depreciation we have got so far since 1 Jan 2019, the day the assets were purchased, until the end of 31 December 2020. So cost is $240,000 and accumulated depreciation is $45,600. Where do we get this from? So here at 31 December 2020, after the depreciation expense for the year was recorded, the total we had in the books was $45,600, which is the cumulative total for the two financial years, $24,000 plus $21,600, right? So cost minus accumulated depreciation, which is $240,000 minus $45,600, that gives us a net book value of $194,400, right? So now the depreciation expense for these old assets in this financial year of 2021 is simply the 10% multiplied on the net book value, which is what we do with the reducing balance method, and that gives us $19,440 as the depreciation expense for these old assets. So altogether, the total depreciation expense for all the three motor vehicles combined for the year starting 1 Jan 2021 and ending 31 December 2021 is $19,440 for the two old assets from previous years, plus $6,000 for the new asset which we bought, altogether which gives us $25,440. Okay? So when we record the journal entry for part F, all right, so what we have to do as part of the journal entry is to record the depreciation expense. Every time we incur an expense, it is always debited. By default, expenses are debited, which means when they increase, we debit them. So we debit the depreciation of motor vehicles account, which is an expense account, all right? And we debit it by $25,440 because when we are recording the depreciation for the year ended 31 December 2021, we are recording it for all the three assets, all right? And simultaneously, we will credit a contra asset account, which is the accumulated depreciation of motor vehicles account. What do we understand by a contra asset account? A contra asset account records the reduction that takes place for a relevant asset account. The relevant asset account in this case is the motor vehicles. So as the motor vehicle goes through wear and tear, it loses value, right? And that loss in value is stored in this separate account, which is the accumulated depreciation account, all right? So accumulated depreciation account by default is always credited, which means when it increases, we credit them. So we credit the accumulated depreciation of motor vehicles account by $25,440. So every time you're recording a depreciation expense entry, you must debit the depreciation of motor vehicles expense account, $25,440, and credit the relevant accumulated depreciation account, which again is $25,440. All right, so what about part G? Prepare an extract of the statement of financial position as of 31 December 2021 showing only the non-current assets section. So we have to do the extract from the balance sheet. So I have a very informal way of showing you here, but you will get the idea anyway. So every time we record our non-current assets in the statement of financial position or your balance sheet, we want to show three separate numbers. The first one being the original cost, the second one being the accumulated depreciation, and the third one being the net book value, which is simply the difference between the cost and the accumulated depreciation. So the assets that we're working with in this case are the motor vehicles, and the total cost of motor vehicles is $312,000. How do we get that? So we have got two assets that we bought on 1 Jan 2019 for $120,000 each. So the total for two assets is $120,000 multiplied by 2, plus an additional $72,000 for the new asset which we bought on 1 March 2021. Altogether, that gives us total cost of these assets to be $312,000, right? And in between 1 Jan 2021 and 31 December 2021, we found the depreciation of the new asset to be $6,000 and the depreciation of old assets from previous years to be $19,440, which gave us a total depreciation expense of $25,440. But that $25,440 is only for the financial year of 2021. We need the accumulated depreciation since 1 Jan 2019. So the total accumulated depreciation for all three assets combined at 31st December 2021 is $45,600, which we had for the old assets in the earlier years, as you can see in the ledger account, all right? Plus the new depreciation expense we calculated for the year 2021, which is $25,440. That gives us an accumulated depreciation at 31 December 2021 to be $71,040. So this is the amount that we record here, all right? And the net book value is simply the difference between the cost and the accumulated depreciation. $312,000 minus $71,040 gives us $240,960, okay? And that is exactly how you get full marks for similar questions in your exams. All right, so I believe you found value in this content. Make sure to drop a like and subscribe to this channel. And check out the link in the description to sign up for the crash course that I'm offering that will help you ace your exams in 2026. With that being said, I'll see you in the next video.